back. Well, Iran says it will release 15 British naval personnel, but crude oil closed down only 26 cents today. Is there more downside now that the conflict seems to be close to a resolution? And what to make of today's oil inventory report? Here with the roundtable discussion on oil is our energy reporter Sue Keenan. Spends her day at the NYMEX, but joining us here, Bill O'Grady, Chief Global Market Strategist at AG Edwards, joining us from St. Louis, and Kevin Kerr, President of Kerr Trading International in Stamford, Connecticut. And Bill, let's just start off with you. Today, of course, what we were just talking about, it looks like this resolution, we're getting a resolution to the Iran situation, but we didn't see oil really tumble. What do you make of that? Because a lot of people said maybe we had a $3 or $4 premium really kind of added into this market over the past few weeks.
Well, it's always difficult to know what these risk premia are. People do throw out numbers out there, and looking at a chart, you could kind of come to that conclusion. We've been working under the assumption this year that OPEC has put some discipline in the market and would probably keep prices in a range between 55 and 65. We got near the top end of that range, and now prices have backed off a bit. But I think underlying this market has been continued economic strength, especially out of the Asia-Pacific region, and persistently slow recovery of U.S. refining capacity to come back on stream, which has helped lift gasoline. And I think that's been an underlying support to the market, and the Iranian situation had gotten a little bit overblown.
I've got a question for Kevin. Even though we saw the current month futures contract down, you look out to the end of the calendar all the way out till this time next year, higher. What does that tell you about where we go from here?
Well, absolutely. I was looking at the December contract before it came in, and, obviously we're seeing higher prices going out, which just tells me we have higher price and higher demand expected this summer and into fall. And I agree that the gasoline is the big driver here. The drawdown we saw in product today was the big thing that held it up, and the refinery capacity didn't even move. So we have a real problem brewing for summer, especially if we have an active hurricane season.
Well, Kevin, continuing on with the inventory report that we got today, it was almost kind of mind-boggling numbers on gasoline here. What do you make of that?
Well, again, we saw a good-sized build in the crude oil, but we're just not seeing that gasoline supply be generated by these refineries, and it was a big draw. I think 5 million, so much higher than expected. And it just tells me that they're stockpiling gas where it's needed, and those supplies are being drawn out much faster than being created.
Well, we saw gasoline futures up better than 4%, so that certainly tells you where the concern is. But I want to ask Bill, in terms of risk, what is the focus right now going forward? Is it more the risk of a shortage of gasoline supply, or that Iran causes more, quote, mischief? As you've said, this latest move may have been the message they're sending to the U.S. about what they can do.
Well, actually, I'm fairly sanguine about what we've seen with Iran. They have, we clearly had all the elements here of a potential conflict. But I think this is almost more of what you saw between the U.S. and the Soviets during the Cold War, basically kind of steps to show, to signal to the other that they are not coming into negotiations from a position of weakness, that they do have the ability to inflict harm on each other. My biggest worry, frankly, from a geopolitical standpoint in the Middle East is not potential issues between Iran, Iraq, or even Saudi Arabia. It's a resurgence of al-Qaeda activity, especially in the Gulf states. That's kind of fallen off everyone's radar screen, but frankly, we're seeing al-Qaeda reconstitute itself, and they have indicated that one of their primary targets would be energy infrastructure in the Middle East.
Bill,
that is actually where I'm watching.
Bill, a quick question about refiners. They usually increase their output, making way for gasoline for the summer driving season, but they're not doing it this year. They don't seem to be doing it. Why is that, given that their profit would actually be pretty good at this time?
It would be. It's kind of one of those great mysteries. What we have been hearing is that after the hurricane events of '05, there was a concerted effort to get a lot of refineries back on stream quickly and to forego a significant amount of maintenance at that time, and that they're trying to do a lot of catch-up maintenance now, and that's why the recovery has been so slow. But frankly, we come into the numbers every week expecting to see a 2 or 3% jump in run rates, and we're just not seeing it. And every week it goes by that we don't see that, the risks of higher gasoline prices go up.
All right. I'm sorry. We don't have Kevin, we had one more question, but we ran out of time. Thank you so much for joining us, Kevin and Bill, and also Sue Keenan. Well, tomorrow is the last day of a shortened trading week. Can the Dow and the Nasdaq add to 5 days of gains, and what could determine that?